Good afternoon all. You are very welcome to our lunchtime webinar series today. By way of introduction, my name is Niamh Geraghty and I'm a partner in Deloitte Ireland. We are delighted to bring you today an overview of the Deloitte Asset Servicer Survey results, which revealed 5 key major challenges that are impacting the entire investment management value chain. Those 5 key items are the role of data management, the continued rise of alternative assets, our modular operating models, ESG, and the impact of COVID-19. So looking at the agenda, we will commence the session with a presentation on the 5 key findings, and then we will follow that by a panel discussion with our distinguished panelists. So I really hope you enjoyed the session, and I'm now going to hand it over to my colleague, Julie Farron, to present the findings of the survey.
Thank you very much, Niamh. So firstly, by way of introduction, my name is Julie Farron. I am delighted to be with you today to present the latest findings of the Deloitte Asset Servicing Survey. Just to give some background around myself, I'm a senior manager on the consulting side of the house here locally in Deloitte Ireland. I specialise within the investment management sector, end-to-end, all things asset servicing, and I'm also a subject matter expert in alternative investments. So probably just to give you a background just around the Deloitte survey, Deloitte runs a survey on a year-to-year basis, alternating between asset managers and asset servicers. And the reason we do this too is to understand the hurdles, challenges, and roadblockers across the full spectrum of the investment management value chain. Asset servicers and asset manager sectors face the same challenges around fee pressures, innovation within their products, expanding regulations, and also unstable macroeconomic environments. Alongside this, we now have obviously COVID-19. So just to give you an overview around how we've approached the actual survey. The survey is organised by 2 of our member firms within our EMEA region, Deloitte Ireland and Deloitte Luxembourg. The survey aims to describe the current landscape, identify market trends and challenges that will shape the future state of the industry, and collect and share points of view from industry leaders. The structure of the survey was covered under 6 themes: general company information, client expectations, challenges and vision, business model, technology, and innovation and projects. As the asset servicing market is very concentrated with a few global players leading the asset servicing landscape, the total number of participants within the survey is actually quite limited. However, they cover half of the assets under custody currently globally worldwide. 10 asset servicers participated between Luxembourg and Ireland, and with a combined 74 trillion in assets under custody between them all. That amounted to roughly 45% of the global assets under custody within the body of the market. With regards to the activities performed when we looked at the general company information, most asset servicers have today developed a one-stop offering covering fund accounting, transfer agency, custody service, depository, and ancillary services. Specialization in one specific area is actually quite rare now in the industry. And in addition to the wide range of activities performed, the majority of respondents operate in both the traditional and the alternative asset classes. The exception to this is the crypto assets, which there are only managed by 10% of the respondents. So if we move through to the next slide, it looks at the 5 main trends that were revealed by Deloitte's survey. So starting from left and moving to right, firstly, asset servicers need to embrace innovation to improve their operational efficiency and to develop better competencies in data management as required by their clients. The second trend that emerged was operating models. So new operating models may require a thorough reconsideration of outsourced and offshore activities. And the question is, can asset servicers reinvent their operational wheel across the value chain? The third one is alternative investments and the rise and continued rise of the alternative asset classes. When given that upward trend, asset servicers need to expand and renew their service offering alongside their capabilities and competencies. The fourth aspect is, of course, sustainability and ESG, the ever-rising challenging star. Investors' increasing appetite for investments that fulfill ESG criteria requires asset servicers to go beyond their existing capabilities. And finally, there is our friend COVID-19, and we will look at whether that was a threat or an accelerator. Moving through to the next slide, we'll start on our first point, which is the role of around data management and innovation. Asset servicers recognize the value of data and customized services for investors, but have not yet realized the importance of criteria for asset managers when choosing a service provider. Asset servicers and asset managers agree on a shared vision of investor expectations. They both have understood the importance of providing investors with a seamless, customized experience and allowing access to real-time portfolio data. However, although asset managers have integrated digitalization in their strategic priorities, it appears asset servicers are still off the mark. Asset servicers underestimate the importance of improving their digital capabilities for their clients. 40% of asset servicers consider digital capabilities to be among the top 3 important criteria asset managers consider when selecting asset servicers. However, in contrast to that, 62% of asset managers consider digital capabilities to be the main driver for selecting specific providers per activity/product. The 2019 Deloitte Asset Manager Survey came up with data points from the asset managers. The availability and reliability of data was widely perceived by the asset managers as the 2 main challenges that they faced. Asset management firms depend upon efficient data processing and aggregation in order to make investment decisions as well as report effectively within the environment. Therefore, the future of asset service roles entails high integration of data and digital solutions, granting a significant competitive advantage to asset servicers who are prepared to act. And as the survey found, 80% of asset servicers share the vision that servicing in the next 5 to 10 years, asset servicers will become the data aggregator of the industry. And specifically noting the role transfer agents will probably play in this, as they are in contact with both asset managers and investors. The role of TA are expected to provide regular statistical data about investor attributes and behaviors. Their importance is set to grow as asset managers are increasingly considering clients' expectations when finalizing trading strategies. Moving through to the next slide and on to innovation, cost pressure is one of the major challenges asset servicers, pushing them to innovate and create added value services. 60% of asset servicers consider significant cost pressure to be a key driver for innovation in the market. There is a strong correlation between investments in technology and operational efficiency. Winning asset servicers spend on average 9% of revenues on information technology infrastructures and kept a positive operating margin between the period 2015 and 2019. In contrast to the underperforming asset servicers who only spent roughly 6% of their revenue on information technology, which resulted in their operation margins dropping by 14% for the same period. It is therefore clear that investing in technology infrastructure is critical in order to maintain a competitive edge. Asset servicers are launching multitude of tech-driven technology projects, mainly in the area of transfer agency and fund accounting. And out of all the exponential technologies that we service the asset servicers on, 100% of the respondents stated that artificial intelligence was the #1 for implementation choice to relieve cost pressure. And when we look at the AI family, that is robotics, process automation, chatbots, and machine learning. In addition to this, 90% of respondents had developed data management system layers to collect and analyze data, and that further emphasizes the importance of the role of the asset servicer as a data manager going forward. Moving on to the next slide, we'll touch on the second trend that emerged from the survey, which was operating models. Outsourcing is not a new phenomenon, and we've seen this more and more with asset managers. They've outsourced the back office, they've outsourced the middle office, and they're now prepared to look at activities in the front office to outsource. Outsourcing is a way for many firms to achieve scale and gain access to capability usually only available to the largest players. Asset servicers are now in a position to intervene along the value chain, allowing modular implementation of value-added services like trading, collateral management, and risk management solutions, all the way up to the asset management and portfolio management solutions. As the front to back service offering develops, 60% of asset servicers consider expanding within the value chain to offer front office services to be a solution to face current and upcoming challenges of the market. 80% of asset servicers share the vision that in the next 5 to 10 years, the lines between front, middle, and back office activities will fade, thanks to technology, which will eliminate lower value functions. And 70% of the respondents will collaborate with front office providers to create the industry's first global front-to-back client servicing platform offered by a single provider. Operating models will be redefined, and asset servicers will support an increasing set of capabilities to be even closer to the investment decision, and will see continued extension of the traditional outsourced activities. Also, to touch on the current operating model of the asset servicers, most activities are still kept in-house. However, there is a high reliance on the offshoring model, which is sending activities to lower cost regions. Within these regions, the asset servicers have built up center of excellences around specific processes and activities within the value chain, leaving the client-facing functions in the more local regions. The asset servicing business model is likely to evolve towards a stronger optimization and externalization. So we move on to the next slide, and it'll be the third challenge or rising challenge around the value chain, and that is, of course, alternative investments. The shift towards alternative investments continues to grow. Quantitative easing, negative yields on the bond market, alongside negative interest rates on overnight deposit accounts in the Eurozone, have given rise to the shift towards alternative asset classes as investors seek out alpha. According to the World Economic Forum, alternative investments have matured over the past 30 years and are gradually becoming part of the financial industry, gaining greater acceptance from regulators and the general public. It is, however, expected that it is, however, entering a period of considerable growth. And the main drivers around that is the macroeconomic drivers, post-financial crisis regulation, and two critical industry trends that are emerging. And that's the increased sophistication of the institutional investor and the retail investor entering the market with capital. From 2015 to 2019, at a global level, the AUM within the alt space has grown by 11% per year, while the growth in UCITS funds has only been 1.1% in contrast. In terms of geographical distribution, both the Asia-Pac region and the EU will experience profound development in alternative space and will see a rise in alt assets over the coming years. The rise of alt classes represents significant growth opportunity, and 100% of asset servicers see the most significant growth opportunities in alternative investments. 80% of asset servicers view integration of alternative products in their offering as a highly or moderately important challenge for asset servicing market. This has been reflected by asset servicers creating dedicated teams and capabilities and competencies to service these asset classes. It is now considered a must-do. Failing to do so would result in asset servicers losing out on new business. Further to this, 57% of asset servicers are building capabilities in-house from scratch, while 14% of asset servicers are building partnerships with their competitors who specialize within the alternative investment space. Moving on to the next slide, we'll touch on the fourth point which emerged from the survey, and that is ESG, the challenging rising star. Investors' growing expectations for sustainable funds are introducing an upcoming momentum in the asset servicing landscape. As sustainability is playing a central part in investment management ecosystems, asset servicers will have to embed it into their strategic agenda. The application of the Sustainable Finance Disclosure Regulation, which was introduced in March this year, means that it is now a mandatory requirement. Most asset servicers have identified ESG reporting as a new area of growth for them. 100% of asset servicers plan to change their processes due to integrate sustainability topics within their own business in the next 3 years. Most asset servicers are aware of the EU's action plan on sustainable finance, and 78% agreed that the related regulations will strongly impact their strategic agenda. They identified that UCITS, AIFMD, taxonomy, and the EU benchmark regulations are strong drivers for operational change. There are also two main areas that are expected to be impacted, and that's the product offering, as they will have to tailor their services to sustainable funds, and their IT departments are collecting data on ESG will be a significant challenge for them. 67% of asset servicers plan to make a significant investment in ESG tools within their product lines. The key issue with including sustainability in investment and reporting process remains the lack of reliable, credible, and comparable ESG data. Today, ESG data is mostly provided by external research or by the rating agencies, and which is often incomplete and unable to be comparable data. To face this issue, asset servicers are planning to rely on both external data and also dedicated research teams internally within there. So moving on to the final slide, which is our friend COVID-19. During the asset servicing survey last year, as we were going through the process, COVID-19 hit. And as a result, we put together a supplement of questions and we sent them out to the 10 participants in order to get an understanding of how they were being impacted by COVID-19. To caveat the results that are in front and are in the white paper, the results are based on 12 months ago and basically giving a state of the nation or just a state of what the lay of the land was 12 months ago. Obviously, the world has moved on in the past 12 months, even though we're all still sitting at home and have Zoom fatigue. But just to run through the main points, and potentially the panel will pick up on this as well, as we did discuss it as part of our preparation. Operations have been impacted 12 months ago is the view of the asset servicers. So 100% of them said they were impacted by COVID-19. 75% at that point in time said the main difficulty experienced was in relation to the NAV calculation due to increased market volatility. And obviously that market volatility led to price breaches within the tolerances when striking the NAV, leading to more investigation into pricing, leading to timeliness issues in delivering the NAV to asset manager. 67% of asset servicers stated that fund accounting activities were the ones that were most impacted at that point in time. And as I stated, things potentially have stabilized now, and that may not be the case with operations today. All the asset servicers have agreed that they are now considering themselves being better prepared for possible incidents of this magnitude in the future. So they are reviewing their operating model, especially their offshore and onshore, and potentially bringing some activities back onshore. We've also seen the opportunity, though, that COVID-19 has brought to the table, and that is around the acceleration of digital initiatives that potentially would not have been prioritized only for COVID-19. 67% of asset servicers are undergoing process optimization and digitalization, while 50% of are ramping up on their digital capabilities, which is exciting for the industry that they are planning to prioritize digitalization. And potentially we may see the end of the fax machine, but that's still to be seen. And then there's the resume to normal way of working. And when we surveyed the participants, Nobody was expecting that we would still be in this position 12 months later. 33 of them had at that time a back to work plan, but potentially that is being rebaselined and re-looked at as we move through the pandemic. So there are the key 5 trends that came and emerged from the asset servicing report. I'd like to take this opportunity to thank you for attending today to listen to the key outcomes. And I would like to hand over to my colleague, Niamh Geraghty, and to our panelists who will deep dive further into the key trends that I've just presented on. Thank you very much.
Thanks, Julie. There's certainly a huge amount of data in what you presented, and I would really encourage all our attendees to go and have a look at that survey, because I think there's a lot in it. I thought you brought it through really well. I think those 5 key trends are really important, Julie, so thanks very much. What I'm going to do now is ask our panelists to join if they can, and switch on their cameras. Hi, Clive. And what I'll get, Mark, hi, and Michelle, I know you're going to join too. What I might get you to do, Clive, maybe if you want to introduce yourself first, and Mark then, and then Michelle, and then we'll get kicked off into the questions.
Good afternoon. I'm delighted to be with the Deloitte team here today. Clive Bellows, Head of Global Fund Services for EMEA at Northern Trust.
Hi, afternoon. Mark McKeon. I run our front to back business, including middle office as well as international product for asset servicing at BNYM.
Afternoon, Michelle Butler, responsible for all of our new business opportunities and existing client relationships across Europe for HSBC Securities Services.
Thanks very much, everyone. So I might kick off on the operating model, and Clive, I might touch on this first with you. I mean, in your view, what will the operating model for asset services look in 5 years' time? I mean, there's a lot of data there that Julie took us through, but be interested to get your views on what that might mean in real life.
Sure, and I'm sure everybody will agree that digitization is going to take a much more prominent part in how asset services, asset managers and their delegates operate and communicate with each other in the coming years. I think that's a given, whether that's increased use of APIs, with portals. We still email and even fax way too much data in our segment of the industry, and that has to change. And then I think the other thing from an operating model perspective is asset services are going to continue to move up the value chain, and I'll use the example now. Northern Trust, we're doing trade execution on behalf of over 60 European asset managers. So I think there's the data digital aspect, and then asset services moving into functions that were the domain of the front office, but are now coming much more in scope.
Thanks, Clive. And Michelle, I might turn to you. What's your view? Like, would you have a similar view to Clive on this, or anything else to add?
Yeah, look, I think absolutely. I think data is critical, and I think that the data that is challenging is the data as it enters and exits the firm. And if we look across the industry, there is a patchwork of data providers, vendors, asset managers with legacy systems. And I think that legacy estate is probably one of the key challenges, but also the key opportunities across the industry to try and get data complete and accurate, because we can all have a data warehouse or a data mesh, but it's only as good as the data you can get out of your legacy estates into that. Same with our clients. So I think it's trying to make sense of that data coming in and out of the patchwork quilt of different sources. And very few asset managers have cracked this. So solutions that look at this effectively are very often complex and expensive. So really the art of the possible with the service partner is to look at solutions we can offer both cheaply and efficiently. But if you look at operating models, I really do think data will be at the core of that and will be driving that proposition going forward. And data management.
Thanks, Michelle. And Mark, I might bring you in here. So data and the role of data. What's your view? What's your view on that? I mean, that was one of the other key trends that came out of this. So from your perspective, in BNY, like, is this something that's something you're looking at? As how do you view it, and how do you view it as well from a client perspective, I suppose?
Yeah, so I think it's very difficult to separate operating models and data. For me, they kind of are so tightly aligned, particularly now when you think about clients thinking about their operating model. Previously, they might have looked at it by function, whether it's looking at middle office, whether it's looking at back office. But I think now more and more clients are looking at when they're thinking about transformation, when they're thinking about their operating models, it's really that full end-to-end, right from front to back. And really, when you think about that, data is at the heart of it. So certainly from a BNY Mellon perspective, we're really focused around data, and there's really two parts. When we think about data, there's two parts. One is around data infrastructure. So what sort of infrastructure do clients need to help them manage their data in terms of what they're trying to do internally, or by just aggregating and creating insights? And then the other piece of it is around actually managing data for clients. So traditionally, clients may have tried to manage data themselves and done it in pockets and in lots of different places. But now, I think as they're looking to transform their operating models, they're realizing that data is a huge burden, and they're replicating data, whether it's feeding different systems in the front office, in the back office, wherever it might be. And there's huge efficiencies to be gained by having a single consolidated golden source almost data management solution, where we wrap kind of services around that on behalf of our clients. And then all of that feeds in as part of the transformation, whether that's looking at outsourcing for middle office or bringing in back office, but also then thinking about the impact of transformation and data on the front office. And Clive and Michelle touched on both of those. But again, it's how do you, from our perspective, we're focused on bringing the tools to the data, particularly in the front office side, rather than farming data out to lots of different tools, because then you've just got a different data challenge in the future.
Thanks, Mark. And you touched on the front office there, and I think all three panelists are saying that, you know, data and operating model are so interlinked. I mean, Michelle, from your perspective, is there a blurring of the lines? You know, Julie referred to it in her opening remarks. Is there a blurring of the lines between front, middle, and back office? Where does the asset servicer kind of sit in that? And maybe you can just give us a bit more of a feel for your thoughts around that.
Yeah, absolutely. And look, we absolutely see that, and we see that with both really asset managers and asset owners as well. And if you look at the likes of Aladdin, you know, which has been with us some, 8-9 years now, in anger, that contemplates an absolute blurring of those lines in terms of an operating model. It's not the only operating model out in the market. And if I look at, say, custody 20 years ago, and we look at how highly commoditized that now is, and then we look at things like, cutting a NAV, and how highly commoditized I believe that will be over the next 3 to 5 years. And then you start looking at the value proposition, and where there's a continued opportunity to add value to both asset managers and asset owners. It really is moving into that front office space, but trying to be part of that client's ecosystem, as opposed to being an external party that's really feeding information back and forward. And going back to my point around, these solutions are expensive, and they're incredibly expensive to maintain. And going back to really what an asset manager wants to do, and that is focus on those core disciplines of asset management, investor distribution, manufacturing, as opposed to the more what I call operational nature of the functions, which an asset servicing partner can absolutely support and help with. So yes, I absolutely do see that.
And Clive, what's your views? I mean, would Northern Trust look at this in the same way? Are you seeing those blurred lines? Do you think that there's a role for asset services needing to be more integrated into what happens in that value chain from beginning to end, rather than being seen as something out on the side?
Yeah, and I think, Neve, I like the beginning to end phrase there. Certainly, from our perspective, we're completely open architecture. So OMS are agnostic. Manager has a slightly different operating model, and for me, it's about providing a menu of services and then plugging and playing depending on the needs of the individual asset manager. And as I've already said, we have a large number of asset managers who've outsourced their trade execution to us, large number of managers who've outsourced currency management to us, but also increasingly looking for us to interface and in some cases operate their OMSs on their behalf. And then you go right to the other end of the value chain. And I do think there's a temptation for everyone to get really excited about the sexy bit of the front office. But the end investor is still critical. And when I talk to asset managers, the experience of their investor coming into a fund, their ability to access their data, online access to status of orders, contract notes, statements, etc., etc. So for us, we've invested just as much time and energy in the investor experience as we have with the interfaces with the front office.
Yeah, I mean, I think it's a really good point in the whole kind of rush to be more innovative and transform. You know, you can forget that the investors at the end of this, and really, you know, you must keep them in mind. And it's like you said, the investor experience is so important. But I guess at the same time, and Mark, I might come to you on this. It's around, you know, cost pressures that are experienced in the asset servicer industry. You know, the innovation that you have to make. I mean, in terms of that whole operating model, the data piece. I mean, there needs to be some innovation around that, right? And you know, at the same time, you've got cost pressures, which probably drive some of that innovation. You know, what are you doing in BNY around some innovative tools that you're using? And I presume you're experiencing the cost pressure that everyone is experiencing.
Yeah, so I think there's a couple of parts to that. I think it's when we think about innovation, it's both around perhaps new products, as well as ways to improve efficiency and scale and the benefits, both for us internally in terms of how we operate and service our clients, but also in terms of types of tools and capabilities we can deliver to our clients that help improve how they operate as an organization. So I think just going back to one of the comments earlier as part of the survey, I think it's important that kind of innovation. I think there was a reference around innovation and AI, where AI and bots and other things are used. I think it's important that innovation and digital go together, because you want to transform how you're operating, not just put automation in, whether that's through bots and other things. You actually want to look and be under the foundation, understand what is fundamentally wrong and address that. But when we think about innovation, as I said, it's really broken down into two areas. One around product development, and how do we deliver new products and services to our clients. So a couple of them are things like our growth dynamics, helping clients think about distribution and giving them insights and predictive analytics around distribution, and given what we see across the organization. ESG is another one, and how do we think about innovative solutions around ESG to try and consolidate and get that kind of complete view. When we think about it, it's around things like crowdsourcing type ideas when it comes to ESG, because it's not a standard view. So really broadly around how do we help clients think about in creating those insights to help them grow their business. And then I think from our side, in terms of scalability and efficiency and innovation to help us on our side, it's really about how do we consume and distribute data to our clients. Again, getting away from faxes, getting away from emailing out reports, as Clive mentioned, and giving clients much better tools to actually access the information they want, when they want it, how they want it. So giving them much more flexibility. And then there's other types of tools. How do we just connect between us, our clients, and the wider network, whether that's leveraging tools like Symphony or OpenFin or Dynamics and other types of tools. So how do we bring that in to just improve the overall experience, delivering efficiency for us, for the client, and just a whole overall better experience?
Yeah, I mean, I think it's a good way to look at it, all right, in terms of, you know, both product innovation and then your own internal transformation innovation. And Michelle, your views on this? I mean, you know, I'm sure from HSBC's point of view, innovation is probably something that you're constantly looking at, and you're probably forced to look at, like all industries are. And where are you on that chain at the moment?
Yeah, look, and as Clive, I think very aptly said, we're looking at it from both the operating model, front, middle and back office, but also the investor vertical as well. So we've done a huge amount regarding our global transfer agency proposition, for example, in the last few years, just purely looking at that investor experience, both from a cost and efficiency perspective, but also how do we get better information to managers to support their clients. And going back to, I think, a point Mark made, you know, clients are very reluctant to pay for their own data, but what they are really, really keen to do is get insights on that data, and those insights, you know, lead to sound investment decisions as well as customer decisions. And again, it's how we get a nimble and very, very easy data to those clients. But I do think cost, going back to your point around cost pressure, it's always been a factor in a commoditized product offering. I think typically there are two levers for that change. You know, remain cost competitive through traditional pricing, and then looking at efficiency solutions from the tech stack, reduction of tech debt, use of RPA, but then really looking at those opportunities to create mutual value with clients. And I think we've moved much more from a product-led business and organization to a solutions-based organization, and no client will have exactly the same requirements. How do we ensure that we keep the client USP and the client IP at the heart of what they do by providing those innovative solutions. But I do think commercial models are fluid. They'll always evolve over time. We'll see increasingly sophisticated tech solutions which will have different commercial outcomes. We see continued regulatory pressure, which really is a cost pressure, and scrutiny on fees from regulators. So I think the role of the asset servicer is to continue to be creative and innovative, to be nimble, and really continue to consider the art of the possible, to really ensure we get the best possible mutual commercial value to both clients and downstream investors.
Thanks, Michelle. And I think you've touched on a lot of the reasons why innovation is required, apart from the cost pressure piece. It's, the investors, the regulator. And Clive, turning to you on that though, while everyone wants to innovate and provide, better and more, better solutions, there's always, that can be hard. There can be roadblocks to that. It's never as quite as straightforward as just wanting to do it. I mean, from your perspective, what are those roadblocks and how can we overcome them?
Yeah, I don't think anyone should underestimate. Change is difficult, and
yeah,
I don't think it's down to any one organisation to hold the key to that change in our industry. And certainly, we rely on our clients, but indeed their delegates. Increasingly the matrix of providers that we are interfacing with on behalf of our clients is increasingly more complex. So everybody needs to be kind of on the same journey towards digitization. But I was also just reflecting on some of the other panelists' comments, and I was thinking back, a decade ago, an asset servicer's main contact point into our asset manager and hedge fund clients would have been the COO, and they're still a critical touch point for us. But increasingly now, we're having just as much interaction with the CIO and indeed the head of distribution. And again, they bring a different lens around what type of connectivity they're expecting. So I think the dynamic between the asset servicer and the asset manager has changed dramatically. But as I said, I don't think any one organisation can come in and just make the world change from a digitization perspective. And I think for me, that's one of the reasons why blockchain hasn't maybe got the traction that lots of people were predicting 4 or 5 years ago, because you can't blockchain something on your own. You need everybody to participate in the ledger. And that's where I think we're seeing that kind of API economy evolving much more than some of the other communication mediums that were maybe anticipated a few years ago.
Yeah, it's a really good point, Clive. I think you're right. I think you can't go out on your own on certain things, because unless the other side is on the same page, you're kind of stuck. I mean, Mark, in terms of that, those roadblocks around innovation, I know you spoke about innovation quite a bit, but what are the roadblocks you're experiencing in your organisation, or even in the industry in general?
I think there's a huge willingness from everyone in the industry. I think it's just about the pace at which people can move. I think there's a lot of capabilities, and you think over the last number of years and the advances that have been made. I think it's just about adoption to start to realize a lot of the benefits that are there today. So certainly on our side, when we think about innovation, we set up a separate team, a separate innovation lab with global presence that are kind of insulated from a lot of what goes on, so that they can really just focus on these things and execute on them. We've also focused on, to Clive's point, just around APIs, our marketplace, which is a way to access all of our APIs. So clients, and as clients come to us looking for, whether it's a new report or a new piece of information or whatever it might be, pushing them towards that API route so they can dynamically just come in and request it. And then we're pushing that more and more as well with our partners. Obviously, there's been lots of partnerships within the industry trying to kind of address some of the needs around the front office, and particularly with the OMS providers. And again, we've built that direct connectivity through APIs into each of the bulk of the OMS providers, so that, again, going back to Clive's point about who did we speak to versus who are we speaking to kind of now or in the future, and it's gone from being kind of the operations people, and now it's much more towards whether it's the portfolio manager, the risk manager, the traders, because of that connectivity and the innovation about giving the end user access to the right information at the right time, as near real time as possible, to help them make decisions.
Yeah, no, absolutely. I might move on to another trend that emerged, and probably not emerged. It's been something that's been there for a while. Michelle, I might bring you in on this. It's the rise of the alternatives. I mean, getting your view, Michelle, on I suppose what do you see the impact of that, and how is that something? What's your kind of go to market on that from a HSBC point of view?
Yeah, so absolutely. So we are seeing absolutely exponential growth in the forecast of private assets and alternatives, and we expect that to double from around 7 trillion today to 12.6-ish trillion in 2025, and we see that across all of our clients, whether that's a pension fund, whether that's insurance companies searching for additional yield, and traditional asset managers, and really looking at the alternative asset management space, really trying to really merge that proposition now. So we are seeing that exponential growth, and we are seeing more demand for traditional solutions. But really, if you look across the current alternative space, it really is a hybrid of providers, often specialist providers. The data is typically quite complex to consolidate. There are a number of different, say, specialist providers out there who do a fantastic job today in doing that. But as we go forward and those alternative investments start to become more mainstream, how do our clients actually start to consolidate some of that data in a single form? So your alternative and your traditional asset classes in a single outcome. So for us, we have been investing consistently on this over a number of years, but really in the last couple of years have put a dedicated private assets team together, updating our current tech stack, but really looking at what that future vision looks like, and conceiving an environment where alternative is really much more traditional.
Yeah, it's a good point, because I suppose we probably want to get the alternatives into that more traditional model that's not so ad hoc, that it's something that we just do as an industry. Clive, from your perspective, do you have the same focus that Michelle has in Northern Trust? I mean, are you seeing the same level of growth in this space?
Yeah, absolutely. I think, again, the growth in alternatives is well documented. I think it's interesting when I look at it, though, because we've always been a major provider in the private equity space. We've long been the biggest fund administrator in Guernsey, which has, for many years been the kind of private equity hub from a European perspective. And I think we're seeing a couple of things I'd call out. Firstly, our existing client base, who are private equity specialists, starting to do their next or most recent capital raisings in more traditional domiciles. And for the last couple of years, that's been Luxembourg. We all know we've got our shiny new vehicle in Ireland, and I think time will tell how that fares against the traction that Luxembourg has undoubtedly got over the last couple of years. So seeing traditional PE houses coming into the more traditional domiciles. But also, interestingly, we're seeing what I would call traditional asset managers start to launch alternate funds and start to go into private credit, real estate, and private equity. And I agree with Michelle. I think we would all like to make alternatives look like traditional assets. The reality is those funds do behave very differently, and like HSBC, we've long had specialist teams who are focused on those asset classes, because there is a different level of expertise, and you do need to make sure that you've got the right focus on them. But I think there's a coming together between traditional and alternative. But the same issues exist, right? Data is still really important regardless of asset class.
Yeah. And Mark, from your perspective, do you think we're ready to take this on in Ireland? Do you think there's much upskilling of capability? I mean, we've obviously, we've been dealing with the alternative asset classes, but to really scale it up from an Irish perspective, is it a capability thing that we need to look at from an overall industry perspective?
I think Ireland, given kind of obviously major players in the space already that are very mature, I would think Ireland is certainly well placed to take advantage of the growth and build on what already exists here. So, and that's, again, just thinking about the more traditional alternatives. But I think obviously another area that we're very focused on as an organisation, and I think the industry is starting to, is just kind of the kind of crypto assets as well. So obviously starting to become more mainstream, or certainly kind of a lot of focus being put on it. It's still very small, but a lot of interest and a lot of funds. Some of the kind of ETFs being launched now around crypto assets. So again, we're very focused on that space as well, and playing a leading role from Ireland in that space.
Yeah, and Michelle, one of the points that Clive touched on was, the fact that Luxembourg is more probably dominant in the private equity space, and maybe, in Ireland we have to play a bit of catch up. I mean, what do you think the Irish fund industry needs to do around this? I think as Mark mentioned, we're well set up. We've got good capability on the alternatives, but in some areas we're probably a bit behind. Do you think is there anything specifically at a fund or at an industry level that we need to be considering?
Yeah, and look, I think Ireland is well placed to do this. So look, Luxembourg invested early into the private equity market and is now internationally recognised as a PE centre of excellence. And I think Alfie played a phenomenal role in promoting Luxembourg as a domicile of choice for PE. And really, I think the Irish funds industry is very well organised. It's supported by a network of specialist professional third-party mancos, lawyers, accountants, consultants. And I really do think it's an entire industry push for Ireland to really get to that position of Luxembourg. But I certainly think there's no reason why the Irish industry couldn't do that over the next few years.
Yeah, I would have thought so, but I totally agree with you. It's probably all of us coming together to package up and brand what we already do. Just, we understand we can do it, and I think it's you're right. It's kind of making that play and being quite bold about it, and just being out there and saying that we can do it. And if we all come together, I think that would be pretty powerful. And Mark, we mentioned data earlier. Now, one of the areas that with ESG and sustainability, obviously data plays a key point in that. And I think Julie referred to that in her opening remarks. How important is data in order to help you serve your clients in terms of ESG and sustainability?
I think it's huge when you think of ESG, and again, from what I understand at least, or what I'm aware of, none of the major service providers are a producer of ESG data. You're reliant on a number of vendors, and then when you look at each of the vendors, they there's no standardization or very little standardization, and some put a higher weight on whether it's E versus S versus G. So it's very difficult to try and get a consistent view from vendor to vendor. So one of the areas that we focused on is kind of that multi-vendor approach, so that we're consuming data from all of these vendors, and then almost the idea of crowdsourcing, where our clients are coming in and then almost kind of sharing their experience around the data and the value, how valuable certain data components are from different vendors for what they're trying to do from an ESG perspective. So data is absolutely critical, but even maybe more importantly is how is that data being used, how is it being shared, so that we can start to get to some sort of standardization. Again, you look at things like SFDR, and while it came into effect in March in terms of defining your approach, I think the biggest challenge still lies ahead in terms of, okay, what does that mean? What are clients going to report in Q1 next year? And because I think it's the interpretation of the data is still going to be a challenge for many, and I think that's where we're trying to help clients think through what they should report in the interpretation of what's required.
Yeah, no, a good point. Michelle, from your perspective, ESG sustainability, is this something that you're looking at from HSBC's point of view, or your clients demanding any solutions from you?
Yeah, absolutely. So we've been looking at this again for a few years now, led by one of our product experts, Chris Johnson, who was previously looking at our Solvency II proposition. So, having spent a few years really talking to over 20 suppliers, discussions with our clients globally, we actually launched a reporting product for ESG in mid-2020. We've got an informed investor view. So again, similar to Mark, we've got a number of leading ESG providers involved in that, and really for ease of comparability, we're trying to represent the approach of an informed ESG investor to our clients, but really trying to help them move the dial. And I think there are a few things really. One, I think to Mark's point, is it an a la carte or set menu? Sustainable investment does take many forms, both in terms of investment type, and I think great care has to be taken to understand the nuances of ESG and variability, and to select aspects of ESG to embed into the TPA product that genuinely add value for clients. I think there's a cost element around that the TPAs do represent an additional intermediary, an additional cost for ESG that we must materially help to solve the client's problems if it is to be really commercially viable. It must be innovative. It has to find ways to add value by building on an existing position as an asset aggregator, for example, and supporting ESG across a very large client base, because again, it becomes then a cost enabler as opposed to a prohibitor. But I still think there is an early stage of evolution, and we're definitely not there as an industry in terms of that journey yet.
Yeah, I definitely think it's one of those things that is going to, it's just going to kind of explode, and it's going to be, who can provide probably the best services and the best innovation around this on any side, whether it's an asset servicer, a legal firm, and a consultancy firm. I think that'll be really important. And Clive, I'm going to move to you for the final area that we're going to talk about today, which is COVID-19. And I don't think any webinar that I've heard in the last while hasn't touched on COVID-19. And I'll ask you a very broad question. I mean, how has it impacted you at Northern Trust and your teams, and how you, both in terms of your teams, but also in terms of how you serve clients, and what do you see is that what's coming out of this? Like, where are we going to land with what we've learned over the last year?
Sure. So firstly, I think everybody will accept that I think our whole industry, front to back, has done remarkably well over the last 2 years reacting to COVID, and I think we can all claim to be a lot more robust than we maybe thought we were. So I think that's a real positive. I'm very much now thinking about what the rest of this year looks like and what next year looks like, rather than kind of looking back.
Yeah.
We firmly believe that we're an in the office organisation, and we're clearly going to be way more flexible with work practices and staff than we were pre-COVID, but I'm still not convinced that the end of the office is in sight, as some people are predicting. And I still think there's a way to go, and I'm still looking to see how regulators have a view on home working on a go-forward basis. And I think the communication out of the CSSF a couple of weeks ago was interesting, and it'll be interesting to see whether the central bank or indeed the UK regulators follow suit with something that's quite prescriptive. So I think we're in a really good place. I think our client base would absolutely say that they haven't seen any negative downturn on service. And certainly this year, we're as busy from a new fund launch, new product launch, clients migrating into us as we were in 2019. So in many ways, it's business as usual. But I do think there's a pent-up demand for real personal interaction. I can tell you now, I'm fully anticipating being at Fund Forum in Monaco in October, and I look forward to starting to see people in person.
Yeah, I mean, I'd have to agree. I mean, the personal kind of touch and the communication and being just in the same room as someone, I think people feed off that energy, and I think it's a good thing. I would say that there will be shifts for sure in how we operate and how we work. But yeah, it'll be interesting to see how that all plays out. Mark, I'm just going to pose the same question to you. I mean, from your perspective, what have we learned over the last year, and how do you see the future based on what's happened with COVID-19?
Yeah, very similar to Clive. I think as an organisation, I think we've performed extremely well. I think for any organisation to go back 18 months and ask the question of how do you think you would have performed by having, I know in our case, 50,000 people at home working from home. I think there would have been eyebrows raised, wondering how that would go. But I think certainly at BNY Mellon, we have performed extremely well. Obviously, there was a spike in volumes and things a year ago or so, but I think then it's over time it's kind of just moved into kind of business as usual, and I think that's just both in work and personally as well. Like, it's people have learned to cope and deal with COVID and the current environment. I do agree with Clive just in terms of I think people want and now realize that maybe that flexibility is an option. It doesn't have to be all or nothing where you're in the office full time or you're at home full time. I think trying to get the balance right and giving that flexibility, that's certainly what we hear from our employees, and as a company then being comfortable knowing that it can work. I know I was certainly excited to come to the office today, first day, to make it outside. Any day outside the office or outside the home is good, but I think certainly from a client perspective, just to touch on that, I think clients have maybe seen it the opposite way. They've seen maybe how they've it's maybe accelerating their plans as they think about transformation as well. Given like they've had to deal with a lot, certainly for somebody like ourselves, huge scale, but for an asset manager, even if it's a global asset manager dealing with that, it's probably had a lot of clients think about what are their core and non-core activities that they really want to focus on going forward, and how to accelerate plans to get there.
Yeah, absolutely. I think it's certainly given any organization food for thought, not just in terms of, you know, how they work internally, but, you know, how they then serve their clients, what that looks like, what do their clients want. I think it's brought up a lot of questions. I mean, clearly there's been the social economic impact, but, you know, from a work perspective, I think there's a lot going on. Michelle, we're running up against the last couple of minutes, but I'd really love to hear your views on this as well from a HSBC point of view. You know, pose exactly the same question. You know, what's been the impact and how do you see the future?
Yeah, so I'll try and keep this relatively brief. I think COVID for us has been global but local. So I think it's been fantastic for those clients, and certainly those asset managers who have obviously been using us over the last year and more broadly have said, you know, they couldn't have done it if they'd been in-house. You know, if they hadn't outsourced to a global provider such as ourselves, you know, I think the strain on some of those organizations, given the spike in volumes, given the activities that we were able to move around different countries, different locations. So I think clients generally were delighted with the service that they did receive during that very challenging period of last March and April, and certainly the resilience that organisations such as ourselves have been able to provide. But when I say it's local, it does differ country to country, and there are specific employment law by country, and we've seen the current situation in India is very different to what we're seeing currently in the UK or say Hong Kong. So for us, from an employee and contractual perspective and flexible working, it is having to look at that really country by country and making sure that the flexible working arrangements we put in place are not only appropriate to the nature, scale and complexity of the roles in which we have and the different job families, but also the country in which those employees are domiciled. But I do think, on a slightly lighter note, and certainly my role is very much working with clients. So from a client lens, I certainly think it will allow us to be much smarter with clients around how and where we spend our time face to face and virtually. So, if I think, for example, before, last January to March, I was on a plane every single week, typically around Europe, but some of those might be, meetings where you're off to Zurich for an hour and you're flying back that day. I can see a situation where we don't do that as an industry going forward, particularly from an ESG standpoint as well. But I certainly think, going back to what Clive said, look, I'm delighted to go back to a physical environment, as well as the opportunity to work virtually. And I have got a number of client lunches booked over the next few weeks, and I'm delighted not to be doing any cooking myself, so not having to eat my own food, but also just getting that physical interaction. And I do think you miss a lot when you're trying to navigate virtually. Even with existing relationships, it's nice to have that personal touch. So I'm delighted to be able to get out and have some normality over the next few weeks.
Yeah, I hear you, Michelle, for sure, especially around the cooking piece. Yeah, I mean, first of all, thank you, everyone, for joining us today. I really appreciate it. That was a really great discussion. I think that there's a lot there. There's a lot happening in our industry. It's an absolutely fantastic industry to be a part of. I think Clive mentioned how resilient we were, and I think that is so true. There's clearly a lot of innovation and change that can happen, but I think it'll all be for the good. And I think there's a lot to be really hopeful for. There's clearly huge growth in this space, and it's a fantastic time to kind of be in the industry, save for what's happened with COVID. But I think we're all probably taking the positives from that, which is really great. So thank you again to Clive, Mark, and Michelle, and thank you to Julie, who took us through the survey at the very beginning. And thank you everyone that joined. Really appreciate it. And obviously, any questions or anything, all of us, the panelists and everything, are available for questions at any time. So thank you very much.
Thank you.
Thank you.